like to again welcome you all. My name is Jarred Sullivan. So I'm a global investment strategist for Ashburton. So I'm in charge of the multi-asset fund series. And today I'm really just going to go through our sort of broad expectations of the year ahead and try really to contextualize what we see as market opportunities, maybe speak a little bit about how we position our funds according to some of the opportunities we see in the market on these slides that we'll come to shortly. But overall, yeah, please feel free to ask questions at any point. So without further ado, I'm going to get started. So I think a key place for us to start is with looking at what our key assumptions are from a global perspective. So we do think that we're going to see quite a sharp rebound in the first half of this year. So we're going to see some very big GDP numbers. We're starting to already see on a high frequency basis the data that is exceptionally upbeat and that is continuing to recover off its March lows last year. So in the first half of this year, I think we're going to see some unprecedented numbers, just as what we saw to the downside at the peak of lockdowns last year. So in that environment, we see quite a favorable demand conditions, and that's one of the main underpins that we see inflation accelerating this year, and also particularly in the US, with the dollar depreciation that has really occurred since about March and April last year, as well as the very low base that we had with inflation troughing, and I think about the second quarter of 2020, those base effects could even potentially lead to inflation overshoots above central bank targets, and we'll delve into some of the detail a bit later on that specific point. We're also seeing policy being incredibly supportive still this year, particularly from a monetary policy perspective. You would see that a lot of major central banks around the world have still committed to their asset purchasing program. So we foresee quite a bit of liquidity still permeating in the market as we go throughout the year. So we think there's going to be more support from a monetary policy perspective, perhaps less so from a fiscal when we view the broader DM space. So overall, with the central bank's commitments in terms of their asset purchasing programs and their future guidance, we think financial conditions are going to be particularly supportive. And this is an environment where commodities do really pick up from the better demand dynamics that we have actually seen more recently. So heading into the first slide, so looking at the budget balance within the US, I think more recently was the presidential elections that we saw back with the Georgia runoffs in January. So now we have a Democratic-led House and Senate. And in that environment, we think that fiscal stimulus is going to still be quite supportive. So if you look at the US budget balance, which is fiscal expenditure minus the revenue they take in, expressed as a proportion of GDP, even analyst forecasts are still, the budget balance is still expected to be quite wide. So just comparing that to the over half a century worth of data, even though it is expected to narrow because of the improvement in growth prospects, the fiscal stimulus is expected to be incredibly supportive. And that's one of the also fundamental underpins that we think is going to really boost growth prospects and lead to further dollar depreciation going forward. So to speak about, I suppose, at the center of what's on everyone's minds lately is obviously COVID cases. And over the past couple of weeks, we were seeing a peak in many developed economies around the world, such as the United States, the UK, European Union, where we saw harsher lockdowns get erected in a lot of these sort of regions. But one key takeaway I would like to take from this graph is that below the world sort of line there, you would see that the Asia-Pacific region has had very contained COVID cases when looking at as a proportion of their populations. And that's also been a good guide in terms of where growth prospects have been, where the returns on equity markets have been, and we've tried to position our multi-asset funds and actually broader Ashburton funds accordingly to take advantage of where growth prospects had been. So thankfully, we have seen the peak already this year come off it in many developed economies, and we are pretty emboldened by the vaccines and the rollout plans thereof, and we hope to see some sort of normalization as we head into the second quarter of this year with the easing of lockdown restrictions. But taking a look at a data point that we watch quite closely, developed by Oxford, is a lockdown stringency index. So the higher numeric you see here, the stricter the lockdown is, and the lower the index is here, the easier the lockdown stringency index is. So as you would see at the top end of the spectrum more recently, you would see the likes of Germany and UK have erected quite strict lockdown restrictions in comparison to many other markets around the world. And it really shows in terms of some of the high frequency data not being as upbeat relative to other markets. So at the other end of the spectrum, we can see Taiwan, which has very little COVID cases, being much more open in terms of economic conditions. And that's really been a considering factor in terms of the emerging market space, and where we like to see opportunity in the market. So Taiwan's been a key market in terms of where we're looking at in terms of opportunities. So looking at analyst expectations for the year ahead, so we have both growth and inflation on this on these charts, and within the forecasted area, you can see that we expect some very, very high growth numbers coming into the market, particularly in the first half of this year. So I don't think we should need to be surprised. We're seeing quite upbeat expectations in China for the first quarter of this year. So pretty consensus for that to see double-digit growth prospects. And that is actually one of our largest overweight positions in the emerging market space of where we see the opportunity, and certainly serve the funds well in terms of our overall performance. But we do see the globe actually improving in a synchronized fashion. So we're in a very unique area where we think both growth and inflation are going to swing up in a synchronized fashion, so go into the reflation stage, if you will. And we think that a lot of economies, in terms of all the support that they've had, and both from a fiscal and monetary policy perspective, is really going to show in terms of growth outcomes this year. One of the key takeaways, I think, from these two slides here, if I point your attention to the right-hand side, the inflation graph over there, you would see that US inflation prospects are expected to overshoot quite starkly in the second quarter of this year. So economists expect on average about a 2.6% year-on-year rebound in inflation. Now, as we all know, over the past 10 years, many developed economies around the world have struggled to reach their 2% targets on a sustainable basis. And we're in a very unique situation where we are likely to see quite a sharp inflation overshoot in the US. Now, it's important to consider in the context of what a Fed policy response will be. So we think that because of the inflation rebound that we're likely to see in the second half of the year, we are unlikely to actually see the Fed response aggressively like the taper tantrums that we have seen in the past. One of the main reasons for this is we've seen communication come from them in terms of an average inflation targeting regime, trying to hit the 2% target on a more sustainable basis, an average basis. And also with their commitments to further provide liquidity to the markets back in December. So we think that they would actually encourage a mild inflation overshoot, where they would essentially rid these fears of debt deflation that we've had for many, many years, and concerns around that. So in terms of debt deflation, we must just remember that a lot of the debt is fixed in many developed markets around the world. So by having a high inflation backdrop, we would get higher nominal wages, higher nominal GDP growth, and quite likely higher nominal taxes come through, which would make the fiscal ratios look a lot better. So we think that the Fed could potentially tolerate an inflation overshoot and view it as transitory in terms of what the inflation outlook will look back then. So we're unlikely to see, from our view, a taper tantrum like we had seen in the past if we do see an inflation overshoot in the headline numbers coming through in the first half of this year. So to elaborate a bit more on the inflation points, inflation's actually already been here. It's been here for quite a while. So inflation actually troughed at the peak of lockdown restrictions in about April last year, where you can see that quite clearly in the CRB commodity index. And that has been inflating ever since. So that's a broad-based blend of many commodities around the world, and that has been inflating quite nicely in terms of the upswing in economic data and actually inflation that we have seen. And you can see it in terms of how what's happening specifically in the United States. You can look at their trade balance in the top right-hand corner, where the US are actually importing more than they're exporting. And the consumer in the US has an exceptionally high propensity to import. That's particularly important in terms of what the inflationary feed-through will be in the future. So we can clearly see that over the last 6 to 9 months or so, that trade deficit has actually widened quite significantly because of the higher propensity to consume, where consumption expenditure has really come back, and it's come back quite strongly. And one of the main reasons that we've actually seen the trade balance as well also widen is because of the higher cost of importing these goods. So you would see that the Bloomberg Dollar Spot Index has depreciated quite significantly. So that has happened at the peak of lockdown restrictions and the subsequent recovery. So one thing we just have to remember is that the dollar is a counter-cyclical currency. So in upswing environments, with incredible fiscal and monetary policy support, investors do look towards taking on their flows towards riskier asset classes. And that's one of the fundamental underpins that we normally see the dollar depreciate in that scenario. And if you actually take a look at the ISM manufacturing prices paid subcomponent, that has been also lifting ever since the lockdown peak in the second quarter of last year. Now, that is a diffusion index, so any reading above 50 indicates expansion in prices paid on a month-on-month sequential basis. So you can see that that index is coming up quite strongly in recent months, and we expect that to start filtering now through to headline inflation figures. So I think the main question from all this is the dollar going to continue to depreciate? And also, what goes up when the dollar depreciates? So a lot of key equity indexes that we watch around the world, such as the S&P 500, the WTI index, oil, CRB commodity index, Bitcoin, emerging markets, have all high inverse correlations. So if you look at it on a 60-day basis, 90-day rolling basis, all the way up to 180-day rolling basis. So that graph there depicts the inverse correlation with the dollar and key equity indexes. So this does indicate that we have been in a cyclical upswing where the dollar has depreciated, and a lot of these equity indexes tend to benefit from that upswing environment. And that's something that we've seen quite strongly and something that we monitor quite strongly. And you would point your attention towards the gold sort of subcomponent there, where it's lost a little bit of its correlation lately. And that's because we are in an upswing environment where nominal yields have risen, specifically in the US, and actually more ubiquitous on a developed market level. We are seeing nominal yields peaking up and less safe haven appeal in terms of what gold offers to traditional investors. So we're starting to see flows more towards riskier asset classes where gold is now falling out of favor in that regard. So our preference would be to look towards more broader commodity blends as opposed to safe haven sort of appeals. Now, the broader graph that we can see here, the red and orange chart, depicts the global manufacturing PMI, so an indicator of high frequency data from a global perspective, as well as the trade-weighted nominal broad dollar index. And you would see that those two have quite a high inverse correlation with each other, about an 80% inverse correlation with each other. So further providing credence to our underpin of the dollar depreciating in a cyclical upswing environment, which we think will continue for at least the first half of this year, with base effects certainly aiding with that, and a lot of the consumer being in a much better position than they were in the financial crisis, which we'll speak about a bit later. So where to from here? We think that the dollar is likely to continue to depreciate. So one of the key metrics that we like to pay close attention to is the forward rate agreement overnight index swap spread, which is a proxy for funding stress in the US market. And you can see that that's been coming down quite nicely. So we think that the market is also adequately capitalized from a liquidity perspective. If you look at the Federal Reserve balance sheet expressed as a proportion of GDP, you would see that that's been increasing steadily in terms of what has happened in the lockdown peaks in March to April last year, and with the further commitments for the Fed to provide liquidity in the market to the tune of about $120 billion extra per month. So that's something that we think is going to continue to debase the dollar. So fiat debasement is likely to continue in the first half of this year, in line with the cyclical upswing, and really erode the value of the dollar, I think, going forward. And quite important to this is what the forecast expectations are for 2021. Now, if we rewind about 6 months and asked analyst projections for global growth, they would say that it would be long-lasting in nature and very difficult to recover compared to what we've had in 2020 in terms of the expected outcome for a lot of economies around the world. However, what we've seen more recently is much more upbeat expectations for the year ahead, heading into 2021, where most analysts actually think that this year is going to completely offset the losses that we saw in 2020 in terms of a growth outcome, and in fact be better off relative to where we were in 2019. And that's particularly important in terms of our view on the dollar, that we're likely to see continued fiat debasement as well as a cyclical upswing that are almost certainly going to be supportive of the dollar in the near term, and something that we've certainly seen over the past couple of months. I think from a house view perspective, we have been particularly well aware of short positioning and for the dollar in terms of that being crowded, but we do think that regardless of a potential pullback that we've seen, I think in the past couple of weeks, on a trend basis, we still see it depreciating. So what has happened more recently is rather episodic as opposed to trending. So we maintain our house view that the dollar is likely to continue to depreciate and actually even lead to a higher reflationary impulse in the United States. So I think it's important to also contextualize what sectors benefit from a higher growth and inflation backdrop. So what I did was take a look at the last sort of 2 decades of data and define periods where both growth and inflation were accelerating in a succinct fashion. So taking a look at the second derivative of both growth and inflation, and seeing, what sectors really benefit from the cyclical upswing. So you would see here that the likes of technology, industrials, consumer discretionary all tend to benefit from a cyclical upswing. So in the green box that you would see there, that's the quarter-on-quarter total return that you would have got on average in a cyclical upswing environment. And these are key positions that we look to in terms of our overall multi-asset fund holdings, as well as broader Ashburton fund holdings as well. And we match the top down with bottom up, getting the cycle dynamics right so that we can get the best of both from a risk return perspective for our investors and our clients. So more recently, we've actually looked towards financials and energy because of the ability of the yield curve to steepen potentially even further, as well as the dollar continuing to appreciate, which would broadly be supportive of commodity prices, particularly in the energy space, along with several other bottom-up reasons as to why we think these are particularly attractive and have been attractive in recent times. Now, I think it's also important to look on the other side of the coin in terms of what sectors don't do as well when growth and inflation accelerate in a sustained fashion. And you would see the more defensively positioned sectors like consumer staples, like real estate, like utilities that actually don't benefit. Discussion around sectors that benefit from cyclical upswing. I think it's also incredibly important to look at sectors that don't do as well in a cyclical upswing, where both growth and inflation accelerate in a succinct fashion. So looking at the likes of consumer staples, your real estate and utilities, that actually have quite a lot of companies that are highly indebted that don't do well with yield curve steepening, so that the rate of change of these cash flow generations isn't as positive relative to the sectors like your industrials, energies, financials, etc., that do benefit from a better growth conducive environment. So that's something that we consider quite deeply in terms of our multi-asset fund positioning, as well as the broader Ashburton funds. Now, I think it's also important to take a closer look at the performance, specifically within the S&P and emerging markets, and I'll speak to some of the sectoral allocations there as well. So over the last 1 quarter or so, you would see that the main beneficiaries from the cyclical upswing that we're seeing in a synchronized fashion have been the likes of your financials that get a positive impact from yield curve and steepening, with the net interest margin being more supportive than what it was entering into lockdowns. In energy, obviously, we've seen the oil price recover quite strongly. We've seen better demand dynamics come through, and we think that could potentially continue, even if the dollar continues to depreciate, which would really be beneficial for top-line growth there. So as you would see here as well, in the more defensively orientated sectors, like the likes of your consumer staples, utilities, and real estate, which haven't done as well over the last quarter, relative to your broader equity market index. So these are things that we really consider in terms of our overall positioning, and make sure that both top-down and bottom-up match in terms of our investment cases. So more broadly, if you look to the right-hand side, you would see that emerging market total performance has been very good over the last quarter. So you would see that it's done roughly double the S&P's performance, where emerging markets have really benefited from that cyclical upswing, have been very good from a high-frequency data perspective, and we've seen a lot more investors emboldened to take money towards riskier asset classes, both from an equity and debt perspective. So that remains a key overweight positioning for us, and it's served the funds relatively well in terms of overall performance over recent months. So to take a look at the snapshot, another important thing that we consider quite closely is concentration. So if you would take a look at the beginning of the year, roughly 16 stocks now account for a third of the S&P's market cap. So very familiar names in there for most of us, for the likes of great companies like Apple, Microsoft, Alphabets of the world, etc. But a new name that has been added more recently toward the end of last year has been Tesla, now contributing nearly 2% to the S&P's market cap. So very interesting dynamics, and also something that we take into consideration in terms of portfolio diversification and where we place funds from a risk-reward dynamic. So to take a look at some of the earnings releases more recently, you would see that analysts have actually been far too bearish, and we think that they're likely to continue to be far too bearish going forward. So pointing your attention towards the bottom side of this, these two tables, where you would see that most companies beat from a sales and earnings perspective, particularly in the energy space, where a lot of the capex cycles have been particularly low, where if there's any upside from a re-acceleration of oil prices, that leads to very good free cash flow generation. So positively surprised in terms of earnings there for energy companies, and more broadly across markets, we've seen quite a strong cyclical upswing, and we think that equities definitely have more investment rates relative to bonds, and we maintain, I think, our overweight positioning from an equity versus fixed income perspective going forward. And we'll delve into some of the details to why a bit later. But it's also important, I think, to consider circular themes that have emerged. So a theme that was emerging even prior to strict lockdown measures was the e-commerce trend. So you would see there in the top left-hand graph, this is the something that is released by the US Census Bureau, and it's data that tracks e-commerce sales as a proportion of total retail sales in the United States. Now, this was a trend that was already existing where more and more of traditional brick and mortar sales were now reverting to the online space. And with the peak of lockdown restrictions, we can clearly see that this just exacerbated that trend. So towards the end of 19, roughly about 11% of total e-commerce sales were, so total retail sales were in the online space. And now we believe that's been a permanent shift where roughly about a further 3 percentage points has been added to that space. And I'll just pick up on this slide where we left off. So one of the key circular themes that I think have emerged over the last sort of 2 decades or so, and has been exacerbated by lockdown measures, has been that of e-commerce. So the key metric that we like to look at is how much of e-commerce sales are now being of total retail sales are in the e-commerce space, and that ratio certainly increased. If you take a look at the end of 2019, it was roughly about 11%. And now it's, as you can see there, the latest data point, the third quarter of last year, it's about 14.3%. And we see that that's likely been a permanent shift in terms of the online space, and a clear circular theme that has been intact for the last 2 decades or so. And if you just take a look at the top right-hand graph, you'll see that internet penetration rates have been on an upward trend. And there's been a lot of beneficiaries in terms of the e-commerce trend for the likes of Microsoft, the Apples, the Amazons, the Facebooks, and Alphabets of the world. And that's a concentration index that we like to look at also quite closely in the bottom left-hand graph, where we look at these sort of stocks as a proportion of market cap, where they roughly make up about 1/5. These stocks we like to look at quite closely in terms of their investment potential and prudent outlook. So as you can see there, they do have return on invested capitals that have been relatively decent in recent quarters, and actually, in fact, over the last decade or so. So something that we think is a key circular theme for us to watch out on going forward. If you take a look at it from a valuation perspective, you would see that a lot of the markets around the world have actually derated. One of the main reasons for that is because there's been positive earnings surprises, like we've showed earlier. And it's been particularly evident in the tech space, where we've seen quite sharp earnings beats in recent times, where analysts have actually had to upwardly revise their earnings projections going forward. So we do think that the theme of e-commerce and the main beneficiaries does warrant something to pay particular attention to, as well as seeing if it complements our valuation going forward. But this is a pretty ubiquitous theme around the world, where you've seen a lot of earnings beats in the likes of the US, Taiwan, China, etc., and something that we think could potentially add alpha going into our funds going forward. Now, to take a look at the investment merit of equities versus bonds, one valuation model we like to look at is called the Fed stock valuation model, where we take a look at the earnings yields versus the US 10-year bond yield. A very rudimentary way of looking at it, but it does provide sort of credence to our investment thesis of equities having a better investment merit relative to bonds. So we don't think that there's likely to be much yield compression going forward, given the fact that we are in a reflationary environment, and the fact that particularly in the US, there actually seems to be a mismatch between how much the Fed is purchasing, even though they're committed to more, and in terms of how much treasury issuances there will be in debt. So in fact, we don't think that the Fed is potentially going to purchase enough. So we believe that will inevitably lead to yield curve steepening to continue, particularly in the first half of this year. So we think from an equities versus fixed income perspective, we see a lot more merit in the equity space, where you can deconstruct that a lot more from a sectoral perspective. So one of the key catalysts for this year, we think, is going to be households. So I would like to point you all your attention to the top left-hand side, where we see personal disposable income in real terms, so change 2012 dollars. So that's a real measure of the purchasing power of income for US citizens. And you would see that that has come off a bit more recently, but it's still well above where it was in pre-pandemic levels. And that is mainly because there's been quite a big front loading of stimulus checks that we all know too well of last year. So in the absence of that, so if you strip that out, so that's the orange line, so less transfer payments, you would see that consumers would be in a much more worse off position in terms of income levels. So we think that because of the quick and speedy support that we have seen from fiscal authorities, it does leave consumers better off financially, and potentially more fiscal stimulus coming through that could really also prop up income levels going forward. Also with the easing of lockdown restrictions and the vaccine rollout towards the middle of the year at scale. Also looking at households from a balance sheet perspective is incredibly important. So if you take a look at where household debt was as a proportion of GDP heading into the financial crisis, you would see that the consumers were heavily indebted. Now, heading into the crisis that we all experienced more recently, the pandemic, you would see that there was only a transitory spike in household debt to GDP ratios. So consumers actually took the last 10 years to deleverage and put themselves in a much better financial position in terms of their indebtedness and their ability to spend as well. And what's also complementary to this is household debt servicing costs, which is on the bottom left-hand side. So taking a look at that ratio expressed as a proportion of disposable income, you would see that debt servicing costs are near all-time lows. So the ability of consumers to service their debt is much easier relative to where they were in the global financial crisis in 2008, 2009. And what's more is if you take a look at savings rates, so savings rates expressed as a proportion of disposable income, so the graph on the bottom right-hand side, even though savings have been drawn down on more recently, it's still roughly 90% above where it was and pre-pandemic levels in 2019. So we think that there will be less need to have precautionary savings buffers going forward as lockdown measures get eased. And because consumers are in very good positions, both from a balance sheet and income perspective, and have plentiful savings compared to recent periods, we think that could be a very good catalyst to equity markets and growth prospects heading into the new year. And also just to consider that household consumption makes up around 70% of total economic growth in the United States, and is very similar in many developed markets around the world. So we think that this theme of higher savings rates, front-loaded stimulus from many central banks and fiscal authorities around the world are going to be incredibly supportive of growth prospects heading into this year. So one of the main beneficiaries in a cyclical upswing has been that of small caps. So if you take a look at personal consumption expenditure and compare that to the likes of the Russell 2000 index, you would see that they have a 93% correlation running back to the last 2 decades or so. And at the beginning of a cyclical upswing, small caps do tend to be beneficiaries in that stage, and they've been recent outperformers. So because of the strong rebound that we have seen and will likely continue to see in consumption prospects, particularly in the US, we think that small caps also have some investment merit from that perspective if you believe that consumption is going to maintain and be upbeat going forward. So just something that we like to look at in terms of, what are the main beneficiaries at the nascent stages of a cyclical upswing. One of also the main beneficiaries of a cyclical upswing more recently has been the likes of emerging markets. So this is incredibly important to consider from a flow of funds perspective. So non-residents, so individuals outside the emerging market sphere, on a net basis have been purchasers of both stocks and debt. Historically, it's been more geared towards debt because of the higher yield that's been offered in many of these markets. But even more recently, stocks, so equity markets have been more appealing to investors of late. So you've seen quite big flows. And if you actually look at the most recent January data, that has continued. And we think that warrants further investment merit in terms of the cyclical upswing, higher commodity prices potentially going forward, and very good data out of emerging markets, particularly in the China space, where the credit impulse is a very good leading indicator for a lot of economic activity that is likely to transpire over the next 3 to 6 months. So flows have been fantastic in emerging markets, and we think that this potentially warrants further investment merit over the next couple of months. Taking a look at broad markets, just comparing forward PE ratios, so looking at the likes of the S&P 500, Europe, for example, and comparing that to the likes of your emerging markets, so the blue line there and the orange line with China making up quite a sharp portion of that, you would see that it does have a better entry point in terms of what you're paying, considering from a forward PE perspective. So that also provides a bit of credence from a bottom-up perspective of where we foresee future growth potential in these markets. What's also quite interesting is that the US ISM manufacturing PMI is quite highly correlated with the US 10-year bond yield. And lately, you would see that the ISM manufacturing PMI has been quite robust, recovering quite strongly off its March and April lows last year. And we haven't seen as quite a sharp recovery in the US 10-year bond yield. One of the main reasons for that is because we have seen US Federal Reserve intervention in terms of treasury purchases, but we still don't think that will be enough to prevent yield curve steepening going forward. And one of the also main reasons that we think equities warrant better investment merit than bonds. So we do believe in the case of yield curve steepening continuing, and if that does transpire, it really does diminish the capital gain return component in your bond yields. And we think that that is not something that we want to partake in, and that's why we've gone significantly underweight in terms of our positioning from a bond perspective, and more so taking advantage of the cyclical upswing, which is more apparent on the equity side. So in terms of the investment opportunity in the fixed income space, we've seen inflation linkers offering relatively good appeal in terms of total returns. So if you compare treasury inflation protected securities, particularly in the US, and compare that to your broad developed sovereign bond index, you would see that you would have actually got a much higher level of return, whereas you would have got negative levels of return by investing in your traditional government bonds. So no longer having that additive in terms of overall portfolios as much as it did in the past. So we think that the likes of inflation linkers that are going to benefit from a cyclical upswing and better demand dynamics, as well as the likes of high yields and emerging market debt in the fixed income space, which are less sensitive to risk-free rates and bond yields movements and more sensitive to default premiums, which are likely to compress in a cyclical upswing, warrant a lot more investment merit in terms of our overall fund positioning. So I hope you heard me throughout most of the presentation. Apologies for the intermittent connectivity, but more than happy to take any questions or to take any questions offline. But please feel free to raise your hand at any point and Edward will unmute you and we can definitely have a discussion. Or again, please feel free to pop any of the questions you may have in the chat. So again, yeah, appreciate everybody's time, and we'll just give it a minute or two for any further questions. Otherwise, happy to take any discussion we need to offline. But hopefully this was somewhat informative in terms of how Ashburton perceive the world going forward.
Okay, I've got one question. I'm just finding Arlene quickly. While I do that, okay, Chris put his hand down again. Chris, I'm gonna unmute you while I just get Arlene. Chris, you should be able to unmute and chat.
I can't hear Chris on my side.
Yeah, so not coming through. Maybe while we wait for Chris, there is a written question by Henry. Would you like me to read it to you, Jarred?
Yeah, please. I can't see it in the chat. Thank you.
Okay, so your view on global equities is currently to remain overweight.
Yes, so our view on global equities is definitely to remain overweight at this point in time. And on the fixed income side of things, we do potentially like to, well, we are positioned in those fixed income securities to more benefit from a cyclical upswing. So we think that in terms of valuation and top-down estimates, we think that equities are certainly going to outperform bonds, particularly over the next 3 to 6 months if we do have yield curve steepening in the developed market space. And one thing I would also like to elaborate on further, if we do have yield curve steepening, normally that isn't as supportive of the carry trade toward emerging markets because the sort of cost of borrowing does increase. But we also have to consider levels that the real cost of borrowing, particularly in the United States and actually many developed economies, is likely to remain negative if you account for it after inflation. So by viewing it from that perspective, we think that with controlled yield curve steepening in many developed economies, we're still likely to see emerging market flows continue to go into those markets, and the equity expectations and returns in these markets also remain very, very attractive from a relative standpoint.
Perfect. I'm going to, apologies if I'm pronouncing the name wrong. I think it's Arlene. I'm going to unmute you. You should just be able to unmute on your side and chat to us.
Okay, cool. Hi, guys. I was actually just sending you the question in the question box. I was just going to ask, in the previous few slides, you also made mention to the variance in growth between the S&P markets and the bonds as well, and later alluded to the equity growth being more preferential. Would you not maybe say that is also caused by, in the recent years, the growth in many new companies which have come up and obviously how they've strengthened? And that's perhaps a cause for that, as opposed to just the measures which the various governments would take on the bonds performance?
So a lot of the equity market performance in recent times has been driven by unprecedented liquidity injection that have really lifted multiple expansions quite high and propped up asset valuations. But also because of circular themes that have been emerging, like the tech that I alluded to earlier. And there's actually been a higher level of concentration in terms of where these earnings come from. So one of the interesting charts that I showed in a previous presentation is we also have to be careful in terms of how much the yield curve can potentially steepen further. So potentially taking a look at fixed income returns at a later stage. But 1 in every 5 companies listed on the S&P have interest expense exceed their corporate cash flow when I last look at that. So a lot of those returns have come from your large cap companies over the last sort of decade or so. But more recently, that cyclical upswing has certainly come from the small caps, which have been quite a sharp outperformer of late. So that's something that we'd like to watch quite closely in terms of the cycle dynamics and where the investment merit is warranted from a TAA perspective.
Yeah, awesome stuff. Cool, thanks.
Fantastic, thank you.
Cool. And then there's a question from Lance. Outlook on the NASDAQ for 2021?
Don't have a particular price target, but I think broader equity markets, including the NASDAQ, tech heavy, I think it still has investment merit. Although a lot of analysts potentially think that markets may be stretched in terms of valuations, but we think as long as there remains a clear catalyst in place, like the e-commerce trend emerging, like a lot of liquidity being in the markets, and consistent earnings beats, if that's anything to go by, do set the tone for a particularly upbeat year. And I think a lot of these returns are likely to be front-loaded in the first half of this year. As we get toward the middle of the year, a lot of uncertainty is really dependent on how lockdown measures are eased and if they're going to be eased at the pace that analysts expect. So a lot of forecasters and researchers think that most lockdown restrictions are likely to be eased in the middle of the year. So if there's any delay in a rollout of a vaccine or any problems in terms of the rollout thereof, that could potentially create problems for investment returns. So something that we need to track quite closely, I think, heading into the new year. So I can see the other questions as well, Edward, so I'll definitely take it from here, if that's okay. I see Henry Kirsten asked on expectations of global bond opportunities, looking at developed markets versus emerging market bonds. It's a very good question. So in that space, we prefer emerging markets, and specifically emerging market hard currency debt that offers pretty attractive yields, that is supportive from the differentials in interest rates from developed markets to emerging markets. And what's also quite important to realize in emerging markets is that the returns that you get aren't as sensitive to risk-free rates. They're more sensitive to the ability to make good on your debt, which has quite a big portion in terms of default premium. So that's something that we pay quite close attention to. And we think that in that cyclical upswing environment, those are likely to compress and give you good total returns in the bond space. And the differentials in interest rate is likely to be supportive of emerging market bonds going forward. However, that is not to say that there's not opportunity in the developed bond space. We think that treasury inflation protected securities offer investment merit, particularly in the 5 to 10 year space. with the rate of change of inflation, being particularly good in terms of total return expectations compared to your traditional government bonds. And considering the contextualizing the economic cycle, if we get the cyclical upswing right with both growth and inflation, investing in emerging market debt and the likes of global high yield bonds as well can actually lower your risk and increase your return in a particular cycle dynamic. So that's something that we look at quite closely, and that's also why we think the emerging market space and inflation linkers and global high yield do offer quite more investment merit compared to your traditional government bonds. And in fact, in a cyclical upswing, government bonds don't have as much investment merit because the capital gain component does get diminished in yield curve steepening, as well as the fact that your standard deviation of returns can potentially be higher in that environment. Heading over to the next question, I see Michael's posted a question about when we expect the Fed to announce tapering given the US growth outlook. I think that'll be some time before that discussions happen. So I don't think that we're going to have any signaling towards the first half of this year. I think we need a lot more certainty in terms of what the economy looks like in a post-COVID world before we get any sort of announcement. So that is still largely uncertain at this stage. But I think if communication had to come, it would likely be more towards the latter part of this year once lockdown measures are eased in many economies around the world. And then to answer the second part of your question, if the Fed were to taper at December 2020 meeting and start tapering in January 2021, at what point should one de-risk and change asset allocations away from pro-EM and short USD-centric positions? I assume you mean December 21 and January 2022 there, so I'm going to answer it in that fashion. So it really depends on the level of communication by the Fed as well as the cycle dynamic that we're in. So if we enter into sort of a multi-year expansion where the Fed has communicated to implement a quantitative tightening at a very gradual pace, that's not necessarily destabilizing of equity markets in general. So very much dependent on what our growth and inflation expectations are with the policy dynamic there. So we don't think that there will be any aggressive tapering measures by the Fed. We think that when that does come about, they are likely to be gradual in nature. And we certainly don't expect that to be destabilizing to equity markets once that does get announced, albeit more so in the medium term. Then, hopefully that answered your question. So away from pro-EM to short USD position, again, all relative to the economic cycle. To answer Kendrick Kirsten's question, a quick look on asset growth in the local fixed interest market over the next 24 months. So government versus corporate versus linkers versus preference shares. So I assume you mean in the South African market. So I would definitely point your attention to one of our fixed income analysts because I don't want to deter any of our outlooks or obscure any of our, I suppose, investment outlooks there. But Michael, do you actually want to answer that question within the fixed income space on where you see value in the local market? Because I can answer, but I want to also make sure that it's part of what we think from a house view perspective. If we could also unmute Michael Grobler there, Edward, if that's okay.
Okay, I'm going to do that quickly, and then after that, then we've also got a hand by Henny once we're done with that one.
Okay, fantastic.
Okay, Michael, we should be able to hear you.
Hi, good afternoon. Yeah, thank you for the question. I was just busy with another matter, so I didn't get the full question, but as far as I understand, it's regarding the value that we see in the local markets. So I'm not sure if it's confined to where we see value in the bond space, on the local government.
Yes, on the fixed income market over the next 24 months in South Africa. Yeah,
okay, next 24 months. Okay, 24 months is quite a long period, I would say, in terms of our current thinking. So a tough one to answer, but I think for the short term, the easiest for me would be to just make the statement that, as we're all aware, we are in February, and with the fact that we are in budget month, the fiscal outlook at this point and how Treasury will present relative to what was expected or guided at the midterm budget will be vital for how bonds perform. Is in the last couple of weeks, I'd say, with the exception of the first week of January, when there was a little bit of risk off, a little bit of volatility in global markets around the Georgia elections. What we have seen is our bond curve has flattened quite substantially. It's been a bullish flattening, and especially this particular week, it seemed to have gained traction where the ultra long end of the curve has rallied very, very sharply. And it's also for the month of January itself has been the outperformer. And that kind of fits with our narrative. It's definitely in line with what we've been expecting, given that at the moment, government's issuance, in terms of the run rate of what they've raised versus what has been required for them to raise, as well as the current revenue picture is looking better than what it was looking in October. So in a nutshell, we think that the budget's going to be, at this point, a positive surprise relative to October. And there is optimism in some circles of the market that they expect Treasury to reduce issuance on the local market in terms of lowering the size of the weekly government bond auctions. Now, what Treasury communicated to us yesterday was that the local bond auctions, they're not going to be altering the size of it for the fiscal year. So that means the current weekly auction sizes will remain unchanged until the end of March, with government's new fiscal year starting at the 1st of April. So we are in the camp at the moment that think that there is a better than even chance, I would say, higher than 50% probability that auctions could be reduced from April onwards. And we think that if that is the case, if that narrative does hold, that it will be, on a relative basis, will be quite favorable for the ultra long end of the curve. We also think that Treasury could issue a floating rate note instrument that will be a new kind of instrument instead of a standard vanilla bond in the short end of the government bond curve. It could be a 4-year instrument, a 5-year instrument. We'll find out after the budget or at the budget. So that together with the fact that the SARB is going to be on hold and the inflation picture is going to be deteriorating slightly, we think that there's a chance that the short end of the curve will find it difficult to rally hard, and that if we're going to see good performance, it's going to be more towards the belly of the curve or the ultra long end of the curve. On a relative basis, 2035s look very good value at this point for people that can't go to ultra long dated bonds. So I think 2035s at this point is preferable just relative to where it's priced, relative to a fair value fit. But having said all of this, in the past week, the rally has been extremely hard. So I think for now, the market needs some consolidation. So I wouldn't be chasing it at these levels. But generally, we like the narrative of a flattener, a bull flattener, and be overweight duration, and prefer for those who have appetite to be long the far dated on the curve. So I hope that helps.
Fantastic. That was a very good summary, Michael. So just to summarize there, a lot of the value is probably still in the middle of the curve from a risk return perspective.
Good. Cool. I think I disagree. Thanks, guys.
Fantastic. Edward, I think we've got time for maybe 1 or 2 more questions here. You did say that someone did raise their hand.
Yeah, so we got Henny with his hand raised. I'm going to unmute you now, Henny. Henny, I have unmuted you, so you should be able to chat to us.
Yeah, thanks. Just in terms of emerging market equities, there seems to be a generally sort of positive view of emerging market equities. Is that specifically sort of emerging market Asia, or does it make sense to look slightly wider than that? And if you look at most of the indices, that would only add Brazil, Russia, and South Africa, I suppose.
Yeah, so a lot of the value is both in China, traditional Asia, as well as a lot of these economies that you speak of, the likes of the Brazil, that have had a reflation of soft commodity prices, that can potentially get better flows and have better demand dynamics going forward. So a lot of the Southeast Asian economies, were hit quite hard, potentially in the lockdown. And, as they come out of it and have easier sort of restrictions and higher commodity prices, which a lot of emerging markets are over-indexed to, it does make way for very good returns potentially going forward. And if you also think of the debt dynamics, once you have a more depreciated dollar, a lot of their hard currency external debt positions, which is dollarized, does also pave the way for better ability to make good on that external debt position. So all these things do paint the way for quite a rosy picture heading into the first half of this year. A lot of obviously forecast risk in terms of lockdown measures, but for now we think it still does warrant investment grade. I hope that answered your question there, Henny.
Let me put you more on the spot. So if I have to choose one of two ETFs, one is the emerging market Asia ETF, and the other one is the emerging market sort of, they look very similar. Obviously, the one's just got exposure to Brazil, South Africa, and Russia, as opposed to only emerging market Asia. Which one should it be?
Well, so it depends on your risk tolerance. So from a return perspective, the one with Brazil, South Africa, etc., could potentially be outperform in terms of their overweight position. But in terms of risk reward dynamics, if you want more certainty in terms of your overall positioning, it would be more prudent, obviously, to invest the other one. But both have very upbeat sort of return expectations for the year. So if you look at sort of what markets are pricing in, it's double-digit returns for both just this year in dollars. So that's a fantastic outcome, I think, to have in this sort of reflationary environments that we have. So yeah, again, down to risk tolerance and how that would fit within your portfolio positioning.
Thanks, Jarred.
Cool. I think that's it on my side and for all the time we have today. I would like to thank everyone for coming. Apologies for the intermittent connectivity. Hopefully you heard most of the presentation. Thank you very much for the engagement. Hopefully it was somewhat informative. And look forward to the future and future engagement. Please feel free to interact offline and enjoy the day ahead.